Hello, welcome to the latest webinar from Crystal Specialist Finance. Today, we're talking about specialist buy-to-let. Given the tempestuous last few weeks, it's a perfect time to dig into the specialist buy-to-let sector in more detail and to give you the opportunity to ask those burning questions, or even to ask about some cases that you're currently looking to place. As always, we need an esteemed panel of guests, and today is no exception. So today, I'm delighted to be joined by Grant Hendry, Director of Sales at Foundation Home Loans, Marylen Edwards, Head of Lending Buy-to-Let at MT Finance, and Paul Huxter, Head of Sales Buy-to-Let at West One Loans. Welcome, everyone.
Morning, Chris.
During the next hour, we'll be looking at the market and giving you the lender view on some of the recent changes that we've all been experiencing, but also looking at some of the opportunities that still exist for us all to write more business in the specialist buy-to-let space for your landlord clients. At Crystal, we've always believed that the specialist market offers a massive opportunity to help clients, and I know the lenders on the panel with me today share the same view. So hopefully by the end of the session, you'll feel more confident in those specialist buy-to-let cases and maybe even have found a home from some of your buy-to-let clients. But we always want your feedback as well. At the bottom of the screen, you have your Q&A button. So please use this to send over any questions that come to mind, and I will put them to the panel and we'll do our best to cover them off for you today. We have a packed schedule, so let's jump straight in. So, by way of an introduction, could you let the viewers know in say 2 minutes or less, a little bit about yourselves, where your USPs are, and what you feel sets you aside from other lenders in the space? Paul, do you want to take this one first?
Yeah, fantastic, Chris. I'm Paul Huxter, Head of Sales for West One. I've been in the industry for 25 years. So feeling every day of it at the moment. But obviously working for West One, we're the UK's fastest growing specialist lender. You might know us from bridging development finance, second charges, but we're a relatively new entrant into the buy-to-let market, having launched the products back in June 2019. But growing rapidly. Our position within the specialist buy-to-let market is very simple, really. We are catering for all of the deals that the high street don't tend to want to pick up or entertain. Really, we tend to find there are 4 reasons that the high street don't really want to look at those buy-to-let deals. There's something about the property that I don't like, so it might be something above commercial, HMO, multi-unit blocks, deck access, those kind of elements. There's going to be something about the landlord that they're not comfortable with, so they might not meet their minimum income requirements. Might be a professional landlord with a substantial portfolio, which they don't like to entertain. More importantly, limited company borrowers. Again, that's something the high street still hasn't really embraced. Other things that we obviously assist with is where the landlord's looking at slightly different letting terms. So they're not just looking at a standard 6-month AST. They might want to do a holiday let, some form of short-term letting, corporate lets. But the big one for us really is landlord exposure issues. Very much keen on large portfolio lending, looking at multiple properties owned within blocks. So really, West One's aim is to help you and your clients through companies like Crystal to obviously pick up all those deals where the high street just don't want to entertain the buy-to-let case for a number of reasons.
Perfect, thank you. Grant, same question to you.
Yeah, so I'm Grant Hendry. I'm Director of Sales at Foundation Home Loans. I've been with Foundation Home Loans now for 5 years, and we've been lending. I still always class us as a new lender, but actually we started lending back in 2015. And from what Paul said with regards to West One being one of the new upcoming lenders coming through, actually we've been around the blocks for a while and probably a more established lender, which is a really good place to be. Last year we were the largest non-bank buy-to-let lender, which was an incredible achievement. And more recently, we've always done residential lending, but it's always been not taken seriously, probably by ourselves or by just really knowing what our position is in the market. So before, I would have said 98% of our business was buy-to-let, 2% residential, and that's completely swung to probably 70-30, nearly 60-40, the direction it's going, which is really important to have both aspects of the business. I think it certainly puts us in a very strong position, especially following on from what Paul said, that stuff that just doesn't fit on the high street. So our main USPs when it comes to buy-to-let is once again that portfolio lending. So as standard, we'll go to 5 million within a portfolio, but we've done portfolios more recently at 23 million. So for the right landlord, and that's where the relationship with your BDM, your IBDM, to make sure that case is packaged correctly will certainly help. but also looking at your short-term lets, your multi-unit blocks and your HMOs that have just become the norm for buy-to-let landlords, that they need to be able to diversify their portfolios. They need to make sure they're creating greater rental yields. So that mix and being able to handle that has been really good for us. And then on the residential owner-occupied side, we do a lot of business for self-employed customers, whether it's we need to take salary and dividends, we need to use 1 year's accounts, share of net profits. They may have 2 or 3 businesses, and we need to take multiple incomes within that as well. And then also the element of interest only that certainly helps, or part and part. So that's kind of the main reasons that brokers are using us. But the high street just is a volume player. So when you look at our average case, our average loan size on residential is 299,000. So we get decent loan sizes. We did a property for 2 million on a property worth 8.4 million, and we offered it in 6 days. So there's some good stuff that the high street just can't handle. And with our proposition, manual underwriting, case ownership, it really helps to support that side of the business.
Excellent, thank you. And Marylen, a quick introduction from you.
Yeah. So I can genuinely say we are the newest lender in the market. Genuinely, having launched the end of July this year. So I came on board at the beginning of July. I have 30 years plus experience in the industry. Exciting times to launch a new lender. And obviously September hit and it's quietened off a bit. But within our USPs, we again are flexible to what the high streets don't do. We don't have any legacies at the moment, any legacy back book, so we can actually physically look at deals, which gives us a bit of a USP over some of the specialist lenders who are busy. We've taken time to look at deals, look at ways to do it, not do it, ask for additional paperwork. I've got a commercial background, so I can look at things and try and get them to work within policy. We've also got speed on our side for that basis as well. And I think it was actually a crystal case last week. We got from FMA to offer in 4 days. Offer came over to the broker 9 o'clock day 5. So that there is the speed there to do things that are urgent for people. Our USPs, we look at quirky. We can look again portfolio landlords. We've got an aggregated up to 5 mil again, like a lot of the lenders, but we have the time to strip a portfolio apart as well and look at what we can and cannot do. So with us, it's still baby steps, but we're trying to find a niche. First time buyers, first time landlords, expats, all of those things we can just take a view on.
Excellent, thank you. So a good background there into the panel that we're looking at today, both from a personal background point of view, but also the background of the lenders that we're looking at as well. So if you have got any questions, any queries that you want us to put to the panel, please use the Q&A button. I'm monitoring that on the other screen. If it looks like I'm distracted, I'm not, I'm just looking over there. So please get them fired through and we'll get those looked at for you. So the last few weeks, it's been briefly mentioned previously, has been an interesting period to put one word on it, both for brokers and lenders alike. So Grant, starting off with you, can you give us the lender viewpoint on what's been happening over the last couple of weeks?
Yeah, it's been very difficult. It's been difficult for a number of reasons. I think firstly, how you price, where you price, the impact that then has on your service as well. So when you look at hedging and you look at what's happened with swap rates, we as a lender have been cautious to this. From both our treasury and from our commercial managing director, when you look at what was happening with swaps around October, it was around 1%, and we were starting to see it move. And from our point of view, we've always tried to be ahead of the curve rather than be looking at it from a glass half full approach. We've tried to go, well, look, let's just step away a little bit. Let's not be top of the pack on rate because we've got to protect that margin the whole time in our position. And then it's literally gone up constantly to the point where we were hitting 4%. Then we had the mini budget, which absolutely threw all lenders, and I feel for a lot of lenders in that position. And it was really kind of concerning what to do, because your back book will be underwater because of where you're hedging and trying to predict. And when you look at forecasts of where swaps were going, they were changing on a daily basis and jumping by 50, 60, 100 basis points. So it was quite concerning from that point of view, from a lender's side. but it has calmed. And I think that's the most important thing that we need at this moment in time, is having a government that is a bit more stable. And we are very reliant on what happens in the markets. A lot of it has been impacted by Ukraine with inflation and everything else that's happened there that's sped things along. Then the weakness to the pound, to the dollar, when you look at commodities, when you look at oil prices, everything is linked to the US dollar. So that hits us in another angle. So from a lender's side, you're trying to constantly protect your book, protect your back book that you've got there to protect mortgage arrears. But at the moment, from where we're positioned, we still feel that if we can get the calm, we can get the consistency without this erratic movement in the market, that we should be okay. And I think for the lenders, speaking on their behalf on the panel, that is when you take a professional landlord, their portfolio is generally very well geared. The ICR is very good. So they've got positions where they can have wiggle room, where they may need to remortgage extra on one, they may need to borrow less on the other, but they can balance it. They run it as a business, and that gives us huge confidence from a lending point of view that actually it's going to be tough. ICRs are going to be tested. That's certainly going to be a challenge for us. But if we can get the calm, and we've seen it in swap rates, I think since Jeremy's come into position, that it has settled it a bit, but that's going to come as a cost to the taxpayers now, because it's not giving stuff away, and that's where it's then going to put pressure on tenants. It's going to put pressures on people owning houses and rates going up. But we had to know that it was going to happen at some point. But from the Bank of England's point of view, they wanted slow and gradual, and we've had erratic. Literally, it's just blown up, and it's very difficult for any lender to try and prepare or try and forecast where it's going to be. But hopefully we're going to start seeing some stability come.
Thank you. Yeah, very interesting take on that. Marylen, anything to add to that?
Yeah, we've probably been a little bit, we've seen it a bit more erratically from a lender's point of view, being new into market. We're pricing in movement with swaps in line with our funder being so new. So we've been changing rates once, maybe twice a week. So it has made a massive impact on what we do. We have we've been having Fridays, getting everything in, knowing everything's going to change again on a Monday. So we've seen that over the last sort of 6 weeks, but stability and looking forward, possibly not next week, the week after, because our swaps are tiered 2 weeks in advance on our products. But hopefully by the end of October, we'll be back to a bit of stability and back at what I would call a reasonable rate or a competitive rate to come back in and start building the business again.
Excellent, thank you. Paul?
Yeah, I mean, I agree with all the sentiments expressed so far. I mean, I was unfortunate enough to live through the 2007-2008 financial crash from a lending point of view. And at some points it's felt that there are echoes of that in the situation we're in at the moment. But to give the brokers confidence, difference between that and today is liquidity. We've all got money to lend. Lenders do want to lend, trust me, we really do. The challenge we've got at the moment is that we're not really in a position to lend £10 notes at £7. And that's what the fluctuation in the swap rates is causing at the moment, that you price products with the best intentions to have them out there long term. Swap rates move quite aggressively in the background for a number of the reasons that Grant mentioned, and subsequently you find yourself with a product that doesn't make any commercial sense as a lender to keep it out in the market. So the challenges the brokers are facing are equally felt by us in the lending market. We are out there wanting to lend. We want to obviously support brokers, support their clients in the buy-to-let market, but some of the economic challenges that are being thrown at us in the background are making it very difficult to actually keep a consistent product range out in the marketplace.
Thank you. And it gives us a nice view. Obviously, we've all seen it from the broker side, with products being pulled and deadlines being implemented to get things moving forward, and then the impact that has on the client's borrowing potential. We had one residential client, nothing had changed at all. It needed to be reoffered because it changed property post-offer, and the lender wouldn't port it across to a new one. The rate had gone up by 1.5%, but the amount the client could borrow had dropped by 75,000 on there. So it put a real big impact on the borrowing ability for that client. Obviously, we're seeing a similar thing with ICRs and where that's moving as well. So it's just about staying close to the lender, making sure that you're aware of what people can offer and where those solutions fit. We've had a question in from Mark saying, where are the swap rates now? That they went north of 5% 3 weeks ago. and where have they settled?
So they've calmed yesterday on a 5-year. You're looking at pretty much 4.5. So it has calmed, but something can happen in the market and it can be back up to 6 again. And that's the fear that you just don't know. And as an example on that case that you mentioned, as a lender, so I had a case that was presented to me where the broker just couldn't submit quick enough. So we give, and we've maintained it throughout, that we will give 2 days notice when we're pulling a product, and we will give 3 or 5 days notice or to convert that to a full mortgage application. And we've kept that throughout. And I'm really proud that we've been able to keep that position. But this broker had missed the deadline for doing that dip. And is there any exception we can make? And when you looked at it, it was going to cost us as a lender £15,000 for that one deal. It was a £200,000 residential case. It's a lot of money for a lender. And you carry that across all of your book that you're carrying, it becomes very expensive. And that's where that volatility comes. So from a broker's point of view, and I know that everybody on this panel and the brokers who are listening in, we completely emphasize from where brokers are at the moment. And that short notice of, you take a high street bank who says, oh, you've got 40 minutes to convert this to an FMA, and you haven't done your due diligence, you haven't done your compliance, everything else you need to do before you submit that case, or you've gone to your sourcing systems to do your illustrations. It's very, very difficult to try and stay ahead of the curve. So from our point of view, we just want to make sure we are being as transparent as we possibly can. But please understand, we're trying to protect the book, and we need to be around in 6 months' time. Otherwise, we all drop off the market if we don't react to the market as quickly as we possibly can. So, but complete empathy for the brokers, because it is very, very difficult on them, and we do feel for them.
Yeah, and it aligns that comment from Paul, lending £10 notes at £7. This doesn't make sense for anyone. So I remember being on a webinar with Hans it was July of this year, and there was quite an alarming graph that was put up about the trend in the swap rates and how they've moved up. So looking at the figures, 18th of October 2021, the 5-year rate was 0.97. September it was 3.8. 14th of October it was 4.9, and it's dropped now to 4.6. So that's money that was costing less than 1% a year ago is now getting on for 5.
The mini budget was 180 basis points, just that one announcement and the fear in the market, and that just throws you out hugely. You just can't react to that type of change. But it is constantly, when you're looking at the forecast, moving from the 16th of September to the 16th of October. It's just completely changed. So it's very, very difficult to predict what the forecast really looks like. So you can only react to the now.
Yeah, I mean, taking on board exactly what Grant said, the challenge that the lending market's got at the moment, and equally we know that there are some things coming down the road in the short term that are going to have a major impact. I mean, the Bank of England literally last week was saying that you're all going to be surprised at what we will do in November. I mean, the market has been commenting from a 0.5%, 0.75% base rate rise. Now they're talking about a 1, maybe 1.25% base rate rise. That again will have to be factored into the pricing that we actually come back to the market with, because that will have a massive impact on swap rates when that does get announced. Yeah.
Well, that's we when you look at America, because we are so close to how they work, and you look at what they did with the Fed, and they moved it to 3.25. And we didn't jump at the same pace. So that instantly will have an impact on us. And we're constantly chasing our tail to try and control inflation that's at 9.9, expected to be 11%. That does put a lot of pressure on everybody. So I think you're absolutely right, Paul, that you will see great, in my mind, literally 2-3 weeks ago when I was at an event, it's got to be 75 basis points. They can't do another 50 or a 20. It has to be quite erratic and go for the 75. But now, as you're saying, 1.25 is certainly on the cards. So, yeah, I wouldn't be surprised if it was the case.
A question coming from Terry, following on from that, what are the panel's thoughts on the latest Chancellor's turnaround statement yesterday, ditching most of the initial tax cuts? Anyone want to take that one?
I mean, it's positive in the sense that it's kind of like holding your hands up and admitting what they'd actually gone to the market with originally was not right for the business, not right for the country, should I say. and the market's reacted to the original mini budget accordingly. So we're now starting to see a bit more of a stabilisation. Perhaps now they're looking at the right chancellor being in position with the right outlook, but also a bit more fiscal responsibility that what is going to be proposed can now be funded without the excessive amount of borrowing that was on the table with the original mini budget that came out that did spook the markets quite considerably. So positive initially. I mean, not very early days at this stage at the moment. There's a lot of meat that needs to be put on the bone, is the honest truth. But definitely a step in the right direction.
Yeah, I think as Grant said earlier, you know, the market has, the reversal has stabilized the market, and it will stabilize the market, hopefully. But then you have the issue with the cost of living and the tenants and everything else that's then going to be impacted by some of these cuts that have been reversed.
Yeah, thank you. Hopefully that answers your questions there, Mark and Terry. Thank you for those. Keep the questions coming in. Obviously, we'll pick them up as quickly as we can and put them to the panel. So with everything that's gone on over the last few weeks, what impact are you seeing from a new business viewpoint? Marylen, start with you with that one.
Yeah, we've just seen our apps sort of go down. I mean, the last 2 weeks of September were what we call crazy Fridays, because we were changing our products, and we were getting everything coming into FMA on a Friday because we had to book the rate by the close of play on the Friday. So we saw, I think it was 9 or 10 one week, 16 the following week, but then we've gone to a crazy price, so we've just quietened down, and we've got catch up time. But hopefully with what's happened now, we'll be back to a stable rate, and we can just start doing business as normal, I suppose is the word I want to say, with the new rates that will be the norm for some time, I think.
Excellent, thank you. Yeah, we've all felt that over the last few weeks. We've had multiple cases where we've had to requote sometimes 3 times in the same week to try and get that through. So yeah, certainly feel where you're going through on that one. Grant?
Yeah, I think what's interesting is you see the swings, and this is what really impresses me, how brokers are quick to react to, let's say, ICRs or what the customer's needs are, and understanding that. So the swing that we've seen towards discounted products has absolutely shot up beyond belief. So before, it'd make up probably 10% of our business is somebody taking a discounted product. Last week it was over 60% of our business was coming in on discounted products, and so it impresses me that brokers are able to react, that landlords can understand why they need to do that, but the benefits of having no ERC. So it's almost acting a little bit as a new SVR in a certain way, to go, I'm not going to fall onto an SVR, I'll take the product, I'll see what happens with the market, see what happens with Bank of England, and then when things hopefully do calm, and as you look at forecasting with swaps that may not be correct, but when it does ease, and then lenders are in a more competitive position to be able to handle that. Because we've been in the market, because we have still maintained fixed products as well, we've blown the doors off the last 2 or 3 weeks. So much so, as I said before we started the call, and that's a really great place to be, but it does come with concerns as well at the same time. So from our point of view, it is that change in landlords' attitudes as quickly as they have, and brokers' attitudes, that's been really impressive, to be fair, how they have been able to react to it. So yeah, that's probably one of the main things that I've noticed, is that change and that swing is certainly coming.
We've seen some innovation from some lenders as well, offering, as you say, products with reduced ERCs coming into the market, which then give landlords the option, when the fixed rates do return with some of the lenders, that they can move across onto a more longer term product. Yeah, it's
we do product transfers, and before, brokers we'd phone them and say, look, just let you know, your deal's coming to an end, this is the rate that we can offer, and they weren't really that interested. They would always look, because landlords were always looking to, house prices have gone up 25-30%, whatever they've gone up now, and we're looking to take out more and buy more property. It's slowed that side of the market down, where actually I'm not going to be able to capital raise because of ICR, because of rate, and I'm just going to remortgage. So PTs is now becoming more important than ever to have a solution for a customer, and we want to keep hold of that business. We don't want to lose it at the end of that term. So yeah, that's also been interesting to see that swing.
Okay, thank you. Paul?
I think you hit the nail on the head, really, Chris. I mean, in the specialist market, we are always about innovation. We're always trying to find that additional piece of criteria, that additional way to assist brokers when other lending options aren't available. West One, as a good example, as you mentioned earlier, we've moved into the discount and tracker market, but our entire product range has no ERCs, because we're very mindful that, fingers crossed, this is a very short-term position that we're in. Landlords may need to take a mortgage today, with the products available today, but with an eye on letting them free to choose and select from products when the market stabilizes, returns to some sense of normality, so they can make the right decision for them in the longer term. I mean, one thing that we've seen is inquiry levels are stable. We're still getting the same level of inquiries we've always received. The challenge that we have is the inquiries actually meeting requirements now, particularly on the stress tests. Because of the interest rate environment that we're in, the increasing base rate in the background, all lenders have had to take a view at what's the right stress test. Where should we be positioning our stress test now to make sure that we're not only looking after the client today, but for the longer term, that they can actually meet the mortgage payments for quite a period of time. So what we're looking at the moment is probably yielding, a property needs to yield somewhere in the region of 5, maybe 5.5% to get some form of sensible loan to value from a lending market at the moment. And that is pushing the market north. The southeast London, you know, you're looking at yields there typically of 1, maybe 2% at a push. They don't quite fit the model at the moment. So certainly the higher loan to values we're starting to see within West One. Midlands and the north is where the buy-to-let market seems to be moving to, specifically the purchase market. Clearly the remortgage market will be one of the engines of our business for the next 12 months or so until the market stabilizes. The purchase market, as I said, we're tending to see the trend now. It's moving north. It's going towards the higher yielding properties. And additionally, with regards to specialist lenders, it's the kind of deals that we cater for, that the more professional landlords are now looking at the higher yielding properties. They're thinking about, is an AST agreement the right thing for this, or do I now look to a HMO? Do I look to a multi-unit block? Do I look to holiday lets? All those kind of situations are coming more to the forefront now, because landlords, as Grant rightly said earlier on, run these things as a business. So if the AST agreement, standard 6-month AST rental, is not going to generate the income to make the business profitable, there are options available to landlords to get higher yielding properties within their portfolio. And again, that's what we're designed to cater for.
Excellent, thank you. Marylen, coming back to you, there's a couple of topics that have come up during that last question in particular. First one be around service levels. So yes. How as a lender are you focusing on maintaining those service levels to brokers and clients?
Part of my background as well is I'm just very service driven, and I think, one, we don't have a back book legacy, as I said earlier, so we are able to deal with cases as they come in, as quick as we can get them done, irrespective of valuations and how long they take. We can turn stuff around relatively quickly. We can look at cases relatively quickly. Going forward, that is something we will look to maintain. MT Finance as a lender has a good SLA reputation in the market, and part of the reason I was brought in is to maintain that through the buy-to-let and to keep that. I sometimes think that when you come down to choice from a landlord's perspective, if it's going to take 4 or 5 weeks to get something done, or 2 weeks to get something done, and there's maybe 20 bips, 30 bips in the rate when we're a bit more stabilized, sometimes rate doesn't matter.
That's a very good point. That's something that we followed through the specialist market for quite a while. Sometimes it is that certainty of delivery. Sometimes it is that speed of approach that can make the difference between acquiring the property or not. So yeah, that's a very interesting point there. Grant?
Yeah, service has been a massive thing for us. If you go back to when COVID happened and when we were blowing the doors off then with regards to business, we were relying on surveyors going out because we had to have physical valuations. We were relying on solicitors to be able to meet the deadlines that were being set for the stamp duty holiday and everything going on there. This time, because we have been more cautious, we're still seeing the good levels of business coming through, but we've made changes on our underwriting side. And for the last 6 months, we've maintained 1 day on SLA. So despite having record-breaking days coming through on business levels currently, we're still maintaining 1 day for assessment of an FMA. Valuations have been reduced. So Connells, who we work specifically with on standard buy-to-lets, have brought their timeframes in as well. So that's certainly helped us with regards to getting an FMA assessed, getting the valuation instructed. When the valuation comes back, the valuer getting his documents right in the first place, and we're not having to raise PVQs to Connells going, you haven't said there's a garage on the property, and there is a garage. All of those bits have massively improved. So yeah, our service levels have maintained at one day, and that's something that I'm really proud of from our new business team, and absolute hats off to them to be able to maintain that level of service.
Thank you. And Paul?
Yeah, very much the same as Marylen and Grant. I mean, West One, we've always been driven by our service proposition. It's really key. We always try to give an answer on an inquiry within hours rather than days. And certainly with regards underwriting, we work to a 24-hour SLA. So if any documentation is delivered to us, we would get a response back within 24 hours on that. We're a big company and we have multiple different product channels. So we do have the luxury of having a very high level of resource within the business that is quite mobile, quite flexible. So if we suddenly get pressure on the buy-to-let side, we can move underwriters across from the second charges, from the bridging division and the new residential division as well, to actually assist, and vice versa. If they need a helping hand and we're going through a quiet period, then obviously we can distribute the resource within inside the business to make sure that we're meeting the demands of each product range.
Thank you. And something Grant touched on there was going back to the COVID service period. I think we all remember how SLAs were pushed at a number of places, valuers, lenders, solicitors over that period. And it only just felt like things were getting back to normality with a lot of those. And then we get hit again with something. It's just always something to challenge, especially in the buy-to-let space, isn't there? So the other topic that came up there that jumped out at me was affordability. And we've had a question come in about top slicing. So a little while ago, a lot of lenders were moving towards that top slicing viewpoint. Paul, I'll start with you with this one as we finished, as you've had the last one a few times now.
Yeah, no, that's fine. Yeah, absolutely. I mean, certainly, I think that's going to be something that the buy-to-let market's going to have to embrace. The stress testing, the challenges around affordability and yields, as I mentioned earlier, is going to be one of the challenges that we all face as the lending market now. So top slicing is an option to actually explore, to entertain, to take a look at, to give yourself comfort that the deal will work in the short term. With regards ourselves, we don't have a published top slicing criteria as we sit here today, but it's something we can look at on a case-by-case basis. Part of the specialist market is all about that pragmatic underwriting manual approach. Does the deal make sense? Can we find another way outside of the rental stress to make the deal work for us and get comfort? If that involves top slicing, then certainly that's something we can take a look at and can consider. But I think that will be something that a number of lenders in our space will have to embrace moving forward now to make sure that the deals work, because the rental stress is going to get increasingly harder. Thank you.
And Grant, same to yourself. I suppose we're in the pressure on that ICR calculation as much as anything else.
Yeah, it's a tough one because when the world is looking rosy, I want to do absolutely everything. I bang on about wanting to do consumer buy-to-lets because we don't do consumer buy-to-lets. But at the same time, generally, as I said right at the very beginning, we deal with professional landlords. We don't deal with accidental landlords who did a let to buy back in 2015, 2016, remortgaged it to 75, 80% LTV, and that's their only form of income that's coming in to pay the mortgage. And so I've gone away from that and I've gone a bit more towards the cautious side. And it's the same with top slicing. As much as it can put a plaster on the situation, it's not a long-term fix for the type of business that we deal with. And I think it's about landlords, about brokers just taking that step back and looking at that portfolio and going, right, what do we need to do? We might need to sell a property to bring the other portfolios down for us to continue to move forward. It's not about lenders taking more risk to take on that type of business. So from Paul's point of view, absolutely, they don't publish it, but they can look at it on a case by case because they've got one property that just needs another £100, but the customer earns £150,000. As soon as you start creeping into it, in that situation, it can work. But from our point of view, you start doing it, it slows down our system. You then have to put additional rules in. You start slipping towards Coventry, who will use potentially top slicing or something along that lines where you've got to have a minimum income. And it just can sometimes, it's something that we'll look at, and I never want to say never, we won't do it. But at the same time, it's about building a business model that allows us to keep moving forward without putting plasters on the bucket.
Interesting take, thank you. Marylen?
Yeah, I think I agree with what both Grant and Paul have said, but also you've got to be very mindful. It would really help the situation of a lot of landlords who've only sort of come into the market over the last 10 years, because a lot of them are now coming out of 5 years with silly fixes at 3.29, 3.59. So they're variable prisoners unless their lender's got a product transfer. But you've also got the historic landlords who have at least maybe a quarter, 2/3 of their or a third of their portfolio on the old silly reversion rates, where it was a 0.25 or 0.5, 0.75 over base, going back to when base was 5.75. So the reversion rate was really low with sort of MEX, BM, the mortgage works. They've just sat on those for 20 years and benefited massively. Again, their income's not going to be there, neither is the newer landlord who's going on to the variable. So you're looking at historic SA302s, not ones that are going to reflect what's going forward. So a lot of that would have to be factored, I think, if a lender was to take that element of risk as to looking at top slicing on net income.
Thank you. From a broker point of view, a lot of the clients that do enter the specialist space, I suppose you get two types of client really. You get the first time landlord that wants to give it a go and has never done it before, and there's obviously homes for that. But then you also get the professional landlord that Grant's talked about, someone that runs it as a business. And within that portfolio, a broker can really add value by looking at the wider picture rather than looking at the particular deal in front of you. I think that's where a good broker can really add value to the buy-to-let clients.
Yeah.
Thank you for that. Jump to another question that's coming from Mark, saying, yeah, totally understand that it's not a liquidity issue this time, but struggling to see where the market goes if rates do go at 6+. So Mark's painted quite a negative picture of foreseeing significant repossessions possibly from Easter next year, maybe a stagnant property market, and hopefully he's just taken a half-empty approach to things. Any comment to any of that at all? Mainly based around sort of the income ratio pressures that people are seeing now.
Yeah, I think that things have sped up. When COVID happened, I can remember being in the office with Hans. We didn't get the government backing that banks and building societies got, and we were really concerned with regards to what was going to happen. And we came out okay, but at the same time, the rate in which house prices went up and rents didn't match it, salaries didn't match it, and everybody has maxed everything that they're doing. So I think it's about, at the moment, about a little bit of realignment of kind of house prices and what lenders do. And it's about being prudent. It's not about keep going at this pace. We can't maintain this pace until things catch up. So by Bank of England coming in, putting that up, trying to slow down inflation, salaries will probably start rising and people's salaries will start going up, rents will start going up. We'll all get ourselves back into the right position again at some point. It's just because there is so many factors into where we are economically within the country at the moment. So I agree. Was it Mark? I think you said his
Mark,
name was. Yeah, I think he's absolutely right to be on the side of glass half empty, but I wouldn't stay with that glass half empty going, we're going to be in this position for the next 3, 4, 5 years. It's just about a rebalance and a realignment of where everything is for things to move forward. So if it means that landlords can't buy houses at the moment, that's not necessarily a bad thing to try and slow things down, because what's happening is you've got a house coming on, a first-time buyer can't get onto the ladder at the moment because they can't react quick enough. You've got a landlord who's remortgaged 10 properties and is buying it cash and then coming to us 3-6 months later and then turning around trying to do a remortgage on the property to then do the property up, take more money out of that property and keep going. And so the rate in which landlords have been growing their portfolios recently, I think has just put a lot of pressure on everybody. So I think it's about, at the moment, just trying to get it rebalanced again. And inflation has caused that.
Excellent, thank you. So flipping that completely on its head then, where do you think the biggest opportunities lie for brokers in the marketplace today? Marylen, start with you.
Ooh, where? I think a lot of, as you said, as you mentioned, HMOs, MUFBs, holiday lets, diversifying to capitalise on the income that properties can generate. Certainly, where affordability will cut costs, you'll have more potential, maybe first-time buyers will come into the city and take up the posh HMOs or the smaller MUFBs just to cut down their travelling costs and sort of be where they need to be for places of work. So that has happened before you see the expansion of HMOs to get the capital return. Rentals, I don't know how rentals can be driven up to meet ICR needs, bearing in mind the cost of living. So I do think we might go more specialist in the market. I think there has to be, unless somebody takes a view on the ICRs for us and says, actually, it can go back to where it was nearly 20 years ago when base was 5.75, your ICR stress was 110, 115. So unless the FCA or the government take a view on that, I do think standard properties are going to be hard to place at this moment in time.
Thank you. Grant, moving on to you. Where do you think the opportunities lie for brokers currently?
Yeah, I think one of the big opportunities is green. So we've got the deadline of 2025 and 2030 for buy-to-lets to be A to C. And so looking at their buy-to-let portfolios that their landlords have got, where are they at the moment? Have they had an EPC done on it? Do they need to remortgage it to make improvements to the property? Is it something that they can fund themselves? But growing that awareness to make sure that they're ahead of the curve. 2025 will be here before we know it. This year is absolutely flown by. And I think actually just trying to take advantage of that position. I agree 100% with everything that Marylen said. So I'm just trying to come with a slightly different angle, because I do think that landlords are looking at HMOs and multi-unit blocks as an important part of their diversification. And Paul mentioned it earlier with regards to short-term lets and holiday lets. Absolutely, I think that having that ability to have somebody in a property and then they're only there for a weekend, or they're there for a week or 2 weeks, whatever it might be, that person then leaves, somebody else goes in. It gives you a bit of peace of mind that you haven't got somebody in that property for 6 months and then can't pay and you can't evict and everything else. So I think that's quite an interesting opportunity for the right type of property for a landlord. But I would really try and push brokers to make sure they're pushing that green agenda as much as they possibly can, to make sure that landlords are ahead of the curve. And if they have a property that is an E or an F and it's never going to get to a C, well, is now the right time to sell whilst house prices are high, and look to buy something different alongside that.
Okay, thank you. Paul?
Yeah, I mean, taking on board everything Grant and Marylen said, completely agree. But I think one of the biggest opportunities that brokers have got is to really embrace the wider specialist lending market. As much as I sit here today representing a specialist buy-to-let lender, West One, through companies like Crystal, do offer second charges. And I think the second charge market will be probably one of the biggest growth markets over the next 12 months. We're going to see, particularly in our world, an awful lot of product transfers happening, where clients have no other option but to accept the product transfer being offered to them by their current lender. But that then causes the question of, where do I get the additional funding from? And that's where the second charge market will step in. So opportunities for brokers is all around the education. I mean, Martin Lewis, love him or hate him, did come out a few weeks ago and say that brokers are worth their weight in gold right now. And I couldn't agree more. Anybody with any common sense at all needs to sit in front of a broker now to discuss their financial options. Take a look at the wider market. You know, they might want to raise capital. They might want to refinance their existing property. They might want to secure a better rate. Right now, the brokers are the best opportunity to make sure they're getting all options available to them. So from my side, now is the best time in the world to be a broker, because everybody needs your services. Just make sure that you're fully educated up on what is available, and make sure you do look at diversifying your product offering to incorporate everything that is available in the market at the moment.
Excellent, thank you. So staying with you for a second, Paul, obviously you've got a foreign national expat product available. How has the recent weakening pound impacted on that for you?
It's been really positive. I mean, being the eternal optimist, you've always got to look at the silver lining in every cloud. And expats and foreign nationals for us has been a real boom. What you're tending to find is that expats and foreign nationals obviously are paid in a currency outside of the sterling. And as you all know, sterling went into freefall a few weeks ago off the back of the mini budget, which has really given the expats and the foreign nationals that additional buying power. They've got more bang for their buck. So we've seen quite a large influx again of investment into cities around the UK, Manchester, Liverpool, London, from foreign nationals and expats who aren't so susceptible to the economic shocks that we've been facing in the UK at the moment. Certainly, you can see some of the challenges that we're facing are UK-centric. As much as the government's tried to play it as a worldwide economic crisis, that isn't actually the case in a number of countries around the world. So again, if you're not in that space, if you're not actually embracing the expat and foreign national market, it is actually quite buoyant at the moment. And there's a great opportunity to investigate that further and have another income stream available to you, because the specialist lending market is designed to treat these clients pretty much as they do the UK nationals. It's a very simple transaction to do, very simple transaction to actually undertake and get through. And it's quite a rewarding transaction as well, from the point of view that generically speaking, expats and foreign nationals do tend to have quite good portfolio presences in the UK. So you may do one deal today, but 2 or 3 deals further down the line.
Great, thank you. Again, there's always a silver lining to come out of things, and weakening pound means one thing for one person, but something very different for someone else.
Absolutely.
Marylen, obviously you mentioned earlier that the MT are a relatively new entrant into the buy-to-let space. How has that journey been for you so far?
Yeah, it was good. We've only soft launched, so we've only launched with a handful of packages and introducers who have an existing relationship with MT Finance on the bridging side. So business from them has been good and consistent. Obviously slowed down a little bit when our rates tipped to late 7s, early 8s, based on our funders guiding. But no, we've had some really good and very diverse to look at. We've had a portfolio, couple of landlord portfolios to restructure. As I said earlier, we've got the time and capacity, and I certainly have, to look at deals where we can make a difference. So there's been 1 or 2 where they've not been looked at favourably within the market because of things the clients had, but we've gone and been liaising with the client, got explanations, got evidence, and we've been able to take a view. So that has helped get deals over the line where we've got that capacity as well. And in this moment of time, I would just like the rates to stabilise so we can just get out there and get our foot through the door, so to speak. But it'll happen.
It will, and we've certainly appreciated that flexibility, that flexible approach where you can speak to a decision maker, run a scenario past someone and get a quick response back.
Yeah.
So that's worked really well. Thank you. And Grant, Foundation recently launched a range of green buy-to-let products. How has the uptake been on those?
Yeah, so it was 2021. I think it was around January, February time we launched green mortgages, and it was slow. It was, I think, being one of the first specialist lenders to go down the green agenda. It was slow to get going. Then it kind of it absolutely shot up around September, October. Then it eased off. And I think one of the big bits is let's say, for example, financial foundation home loans have a rate at 4.5%, and Paul had a rate at 4.3. Why is the broker going to come to us just to have a green product? So I think there's still a lot of work that lenders need to do. But we've seen another spike again more recently, and it's this journey we're going on of brokers being aware. And it's not so much they've picked a green product, it's more, is the property A to C? So when you look at our back book, 40% of our business is at D, and it's at 62, I think, SAT points that you call them. So they're only 8 points away from getting to a C. And at the moment, it's not as daunting as it could be, because that could just be, has the property had loft insulation fitted at 270 mil or whatever it might be. And I had an EPC done on my house, and I followed the guy around the house. I think it scared him off a little bit, but followed him around the house to say, well, what are you doing? He goes, well, I'm looking at your light bulbs. I'm looking at the cavity wall. I've gone up in the loft. So I followed him up into the loft, and thankfully we had the loft hatch fitted with a polystyrene on the top of it. And he said the amount of properties we go to that will have 400 mil of loft installation, but will have a wooden loft hatch like the original one. He said all it does is create a chimney, because it doesn't matter how well that's insulated, all your heat is going to go up there. So I think it's really is important that brokers are educating landlords around how you can make your property more cost effective. because that will help with the rents that you then charge a customer. So you charge them a little bit more, but the reason you charge them more is their bills are going to be less. It's not just about having an air source heat pump and solar panels on the property. It's about making sure that you've got LED light bulbs. Have you taken advantage of any grants available for changing the boiler? All of those things can get you 5 to 20 extra SAT points that could very easily trip you into being a C. So we're just trying to do that educational piece. And at the moment, we want to evolve our green proposition. We want to be able to give further grants or further advances to allow a customer we give them the money to get the work done to the property, or do they use a second, as Paul said earlier, to get the property to a certain standard. So we're seeing it going in the right direction, and it's probably at the pace in which we would have expected. But I think it's about lenders evolving that side of the proposition to continue to bring awareness to it and improve that journey. But it's looking okay, looking all right.
Thank you. We've had a question come in that I think is specifically for you based around that. Do you think the government may extend the EPC deadlines given this year's turbulent economy and the current conditions?
I think the issue we've got, and I didn't really want to get too political, but the Conservatives have bloody messed this up beyond belief, and they don't know what they're doing at the best of times. And with a Labour government going in, how they're going to treat landlords, how they're going to respond to landlords, and that's what's going to be interesting. So do I think it's going to move? It might move, but I think it still needs to be done. Our carbon emissions and the amount of emissions that are leaked through properties, it has to be addressed, and that's our responsibility as a country to be addressing that, and property is a very good place to start. Will they soften it for landlords? Potentially. They may move that 25 to 2030 and bring it all together. But I honestly think that if you look at your own bills and how much that's gone up, we have that responsibility. You want to do everything you can to reduce your bills and how much it's costing you to run your houses. So I don't think it's necessarily a bad thing to keep that in place. And it seems to be fairly hard, but they may soften it. Who knows what's around the corner?
Thank you. So moving on to the time's literally running away with us at the moment, which is always good. Marylen, if I move on to you, can you give us an example of a recent case that you feel really showcases MT Finance's criteria and ability to lend?
Yeah, I'll give you the crystal one. So we had a lovely case come in. It was talked through with one of our underwriters on the Tuesday. They submitted the DIP and FMA on the Wednesday. We had the VAL booked, VAL done on Friday, VAL report came back Friday night, and we had it all approved for offer on the Monday, and the offer went out Tuesday morning. So it was like literally 5 working days. Thankfully, the valuers were quite quiet in the area location for your property, so it was literally booked and done within 24 hours, and the report back the same day, which the way valuers have been over the last 6 weeks was totally amazing for us as well. So yeah, that helped massively. But it was just the ease that we were able to do it, and I have to say the packaging was superb. I have to give that helped. We didn't have to come back and ask for reams and reams of information.
Great, thank you for that. That's something that we drive ourselves internally on the quality, but something that we also try and put across to all of our brokers as well. Because if lenders do have quick, short turnaround times or deadlines, products being pulled, we can only work as quick as the information that's being passed to us the majority of the time. And from a lender point of view, you'll be seeing this yourselves. If you get poor quality cases in, it just creates extra work and it causes that backlog from a process point of view. We're exactly the same from a packager. The quicker we can churn cases through and get you the perfect packs that you need, the quicker we can get the rates secured, the quicker the client gets the outcome they want, and it just delivers that service to everyone.
Yeah, and I think the market would work much more efficiently if everybody followed that mantra, but there we go. That is one of my wishes, that I don't think you'd ever see completely perfectly packaged cases across the board, but you never know.
Yeah, we can try it. Paul, on to you, an example from West One.
Yeah, just a very brief example of some of the pragmatic approach and more manual approach we can take to things. We had an experienced landlord, had a portfolio of around 35 properties with a total value of about 11.5 million. Came to us to raise an additional 3 million, give or take, on 8 of the properties. It was actually 3 HMOs and 5 residential, so a good mix within that. But the challenge that he had was he was running a business in the background, and one of his suppliers had actually put a CCJ on him a nominal CCJ. It was only a couple of £1,000, but the CCJ was put in place and was currently outstanding. So when the deal was presented to us, it was on the basis that we'd actually take a view on the CCJ and obviously give the client the best products that we had available at that point in time. We dug into the CCJ, we dug into what happened, and it was actually in dispute at that point in time, and it was actually going to a court hearing. So we were comfortable to actually run the deal based on the background of the client and the existing portfolio they had, the experience they had, to run the deal through on our standard products without taking any loading at all for the adverse credit that was sitting in the background. And we took that pragmatic approach, and luckily, should I say, luckily for the client, before we actually completed the deal, he actually got the CCJ suspended and dismissed by the courts. So the broker was over the moon, really, because placing that with other lenders and actually presenting that to other lenders, everyone was taking a view that he had adverse credit and either wouldn't lend or would obviously load the rates considerably to take into account the adverse he had sitting in the background. But our view was it was a good client. It was a hiccup. We could see that it was actually going into dispute with it. We were comfortable completing that deal, even if the CCJ hadn't been dismissed. But as it happened, it happened within that space of time. And again, we didn't stress test the background portfolio, which is one of our USPs. So at that point in time, everything fit very comfortably on the ICRs, and we were able to deliver the deal that the client was actually looking for.
Okay, excellent, thank you. And Grant, an example from Foundation?
I was hoping you were going to say, well, that's it time, because I'm really pleased that I've survived this without being asked any specific criteria questions, because my knowledge of our actual criteria is very poor. So I haven't actually got any exact examples of a great case that we've done. I think that one of the closing bit that I would say is that I'm really pleased from an underwriting point of view how they're dealing with brokers. So once the mortgage offer is issued, we send out a FIFO review to the broker, and the amount of times that they're feeding back with regards to communication being good, clear, concise, the underwriter picking the phone up, looking at a can-do attitude, I think has been really, really impressive. So I think collectively I'm not seeing individual cases coming onto my desk so much anymore, which is a good thing, I think, with regards to the direction that we're going. So
excellent, thank you. So while I've got you then, 30 seconds or less, a quick message you'd like to give out to the brokers about the buy-to-let market. Start with you, Grant.
Oh, okay, thank you. I would just very quickly just say that the need for a broker, similar to what Paul's already said, is more important now than ever before. So to really make sure that you are speaking to your landlords, don't be reactive to them, be proactive, make sure you're aware of everything that's going on, what their intentions are with their portfolios, with their buy-to-lets, what they're looking to do, but just be as proactive as they possibly can be at this moment in time.
Excellent, thank you. Marylen, quick message from you.
Yeah, just reiterate what Grant says, really. Sometimes too many brokers are quick to just source, give the client a rate and move on to the next deal. But if they've got more than one property, just to take that time, have that conversation, look at ways to help them. That extra 5 minutes where you've maybe missed one small deal could get you 3 or 4 or 10 or 20 more deals, just from recommendations or helping out that one client.
Brilliant, thank you. And finally, Paul.
Message to you all is be optimistic. Having been in this industry for quite a considerable amount of time and gone through a number of shocks, this isn't unusual. We are a resilient market. The lenders want to lend. We will come back. We will support you during this period and also longer term. But really, my message to you all is stay close to the lending market, stay close to people like Crystal, be involved in these kind of educational pieces, these webinars, and make sure you do understand all of the products that are available to you and your clients out in the market, because you may have to come out of your comfort zone now and start looking at some of those more challenging products, second charges, bridging finance, development finance, all the kind of options that are available that, you know, lenders will happily talk to you about and actually give you some options that you may not have explored previously.
Excellent, thank you. We've gone just over the hour, so that brings us to the end of today's session. And you'll be pleased to know there are a number of topics we didn't actually get time to get onto, so we'll save those for next time. So thank you all. I hope you found that useful and that you've now got more confidence when you're looking into specialist buy-to-let cases, and maybe even found a home for some of your clients as well. Our mortgage desk at Crystal is open and the team are ready to take your calls to discuss any scenarios. We're used to seeing unusual cases. You know, we don't think anything's too tricky or too unusual, so please pick up the phone, speak to us, and we'll let you know quickly what's possible. We've got extensive knowledge of the criteria of the lenders on panel today, And if we can, we'll certainly put you in touch with them to get you deals moving forward. But just for me, I want to say a huge thank you to our panel. Paul, Grant, Marylen, thank you for your expertise today. It's been really interesting, really useful topics covered. And finally, a big thank you to everyone who's tuned in today. And I hope to catch you all again soon on the next Crystal webinar.